Moving on to the next topic, which is accounting cycle. Now, accounting, as I explained earlier, is the process of recording, summarizing and communicating the financial information of a business to its users. The accounting cycle in any business starts when the accountant first identifies the transactions and the events that have to be recorded in the books of accounts. The second step is to measure the transactions in monetary terms or in terms of money. Now, transactions that cannot be measured in monetary terms will therefore not be recorded in the books of accounts. The third step in the accounting cycle is to record the transactions in the appropriate journal. The journal books are known as books of prime entry, and the transactions are always first recorded in the journal books. In step 4 of the accounting cycle, the journal entry gets posted to the respective ledger. For example, purchase transactions would be posted into the purchase ledger, or cash transactions might be posted into the cash ledger. Now, this step ensures that the transactions are properly classified. In the next step, the financial information posted in the various ledger accounts are summarized in order to prepare financial statements of the business for a particular period. Now, in step 6, the financial statements prepared are analyzed with the help of various tools and techniques employed by accountants. Analyzing the financial statements can help in interpreting the financial results for the benefit of the stakeholders. Interpreting financial results is critical to enable the stakeholders to take more informed decisions. Hence, interpreting results is the 7th step in the accounting process. The last step of the accounting cycle involves communicating the financial results analyzed to the users by way of financial statements or management reports or forecasts and projected financial statements for the future. Moving on to the next topic, limitations of accounting. In accounting, we only record transactions that can be quantified in monetary terms. So, important business indicators such as the skills of the workforce or customer loyalty cannot be assigned values and therefore do not get recorded in the books of accounts. The second limitation of accounting is that accounting is not free from bias. Differences in the interpretation of accounting standards, use of accounting estimates, policies leads to a lot of subjectivity in the way financial statements are presented. The greater the use of judgment involved, the more subjective financial statements tend to be. The third limitation of accounting is that historical cost is one of the most commonly used basis for measuring assets in financial accounting. Use of historical cost fails to take into account changes in the price level of assets that occur over a period of time. This therefore reduces the relevance of accounting information by presenting assets, particularly fixed assets, at amounts that may be at a far less value than their current market values. One of the biggest limitations of accounting is that financial statements can be manipulated by accountants to achieve predetermined results. This is popularly known as earnings management or window dressing. This practice can severely undermine the credibility and reliability of accounting information contained in the financial statements. We have seen several examples of this happening over the past few decades, including the more recent Satyam scandal in India. Now, in spite of the limitations, accounting is a very dynamic profession that has consistently and constantly adapted itself to changing information needs of its user groups. Accounting continues to play a very important role in efficient management of businesses worldwide. Now, before we end this module, there is just one last point that we need to discuss. We often hear the terms bookkeeping and accounting used interchangeably, although the terms have completely different meanings. The term bookkeeping refers to the record keeping activities of accounting, that is, recording the transactions and events of a business in the books of accounts. Bookkeeping, therefore, can be considered to be a subset of accounting. Accounting, on the other hand, is a much broader term and includes, amongst other things, designing a very robust bookkeeping system, ensuring that the internal controls are in place to capture and record accurate accounting information, accurate and timely bookkeeping, analyzing financial information and taking corrective actions as required. Accounting, therefore, involves the exercise of judgment by the person responsible for converting data into meaningful accounting information. Now, it is this process that distinguishes accounting from bookkeeping.